Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Funds and Value Research. You must have heard many investment gurus tell you, stay calm when the market is volatile. How easy it is to follow this advice. This is what we're going to be discussing in today's Investors Hangout with the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
How important is planning when it comes to avoid the market volatility?
You can't avoid market volatility. Markets are always volatile. The definition of market volatility has been distorted. People like the volatility. They don't complain about it if the market is going up, because markets always go up and down. But if the general trend that it is that it's going up, people don't mind that. Only when the markets go down that people say markets are volatile. That is not volatility. Volatility is something going up and down, and that is the character of the market. That is how it will be. I don't think it is going to change. Now you have to configure yourself that when markets turn volatile and it's in a downward way, what will you do, or are you geared for that? And for that you need to do few things, which is very basic, which we keep repeating in Investors Hangout time and again. And even at the cost of sounding like a stuck record, I would like to say that to stay calm in a volatile market or in a downward market, in a crumbling market, in that context we are referring to volatility, is that if you have done the basics, divided your long-term investment and short-term investment, investing only your long-term investments into equity or anything to do with equity. Investing into equity should be a periodic thing. It should not be a lump sum. And if you have done these three things, you will stay calm, because the problem is built only when you haven't planned for it. You randomly came into the market, you got greedy, you got inspired by the recent past performance, something did well, and you invested because expecting that it will continue, and then the market turns downward. That is when you panic. If you invest your short-term money, you will panic, because if you have your son or child going into college 8 months from now, and if that money is in equity, you have reason to worry. You should take, and you will panic. You can't stay calm. So if you have these basic rules in place, if you are following this basic framework of which money to invest and how to invest that, and then comes, which kind of vehicle to invest, because depending on your experience or depending on the criticality of the money where you want to invest. So, if you have this basic foundation in place, you'll be okay. In fact, you'll rather feel happy when markets turn volatile, because if you're investing for next 10 years, then I would like the market to be in great difficulty for 8 years and do exceedingly well in the last 2 years when I need the money.
But you can't plan that.
But you can't plan that.
Yeah.
So what you can do is, if the markets go down, and if you're investing for 5-7 years, you are buying cheap.
Okay. What is the point on which I as an investor see that, volatility is happening, as you say, and it's going down? Which is that point where I should act?
Broadly, if you have followed the, if you have followed the principles of, how to divide your money, allocate your money,
the
and all
bucket
that.
system and all that.
Bucket system. But besides that, there are 3-4 things, because it depends on which cycle of your investment, which cycle, where you stand in your investment life cycle.
Okay.
Assuming that you have been doing this, you have been investing for 15 years, you have been investing gradually, now you have accumulated something sizable, and now you are going to invest for only 3-4 years. You are still in the accumulation phase, you don't need the money. That is the time when the markets go up, and assuming that, let me give you an example. You started investing 10,000 rupees a month, and that was a constant thing, and you kept doing this, or 12,500 rupees a month, the way you do it, like in PPF, you started doing it in a tax saving fund. And then the whole accumulation has translated into something like 1 crore of rupees after 15 years. Right. And you still don't need the money. You might need a part of that money 5 years from now. But when you see 1 crore of rupees going down in value by 10%, it becomes 90 lakh. You worry, you panic. You panic less because you have seen the whole accumulation. Had the money been in PPF, it would have been just about 40 lakh. But that's okay. You see that something which you could have realized, which was worth 1 crore of rupees, has in a span of 1 month has become 90 lakh rupees. That causes panic.
Okay.
So I think that there are 2-3 things to do. One is that have your goal orientation. Second is don't look at too much of news, because there is too much noise, and the news media is built around talking something very intensely. They're doing their job. The news is played up in a manner that it's scary. Likewise, the converse is also true. When the optimism grips in, then they try to build it that it's going to be a completely different world 6 months from now, 1 year from now, or magic is going to happen, which may not be the case. Likewise, the reverse of that is as true. That when just about a month back, it looks like there is a doomsday being painted, that oil price is going up and it will never stop. Rupee is depreciating and it will not stop depreciating forever. Industrial production will come to a standstill, or
very poor sentiments.
Very poor sentiment, and these sentiments swing very dramatically in a brief period of time, and this does not help, because business, you have to see that if you're investing for 5 years, 10 years, it's a general bet on economy. Will we be better off? Will we be consuming superior products and services, and companies will not only prosper but thrive? If you have that orientation, you have to ensure that some of the basics are in place. You are investing in a fund, or if you are investing directly, then you are diversified enough. You are not taking unusual. You have the usual checks and balances. What I referred in the first question, investing long-term money, this. Likewise, investing regularly, diversifying your money, and one critical thing which one should keep in mind, as we keep talking so much about investing for the long run and investing regularly. As you get closer to your goal, disinvesting regularly and realizing that money before you need that money well in hand. Touch this aspect, but this really doesn't. It does not dominate our mind. That is also a very important thing which will help you stay calm. Because you will be assured that your goals are not going to suffer. You will be not deprived of an opportunity of your lifetime plan not being put to use, because at the last moment you will be entirely dependent on the market.
It is said that the markets, when they are down, is a good time to invest. So what would your advice be for the young investors? It's volatile, stay away, or go into it?
No, as I said, that draw a plan, stick to it. And bad market is a good time to start, because that is the investments made at that, when you start there, you are more unlikely to go wrong.
I like what you said. 8 years, bad market, good. But 2 years should be.
You need to, but it's very hard to guess. I would expect that the market to be in a very terrible state and then do very well. And it happened once, if you look at what happened in the market from 1992 to 2002, market did not go anywhere. It did go up and down, but Harshad Mehta scam, 1992, market touched a high of 4,000. Sensex was at 4,000. We saw the big churn, the Great Indian Reform, everything changed. And once again in 2002, we were back to 2,800. Imagine 10 years, 10 historic years in which the country changed and the markets actually came down substantially. And this whole pent up of the market gains. Then we saw that in the next 6 years, 2002 to 2008, market went up from 2,800 to 20,000. So if you were able to, assuming that you had the patience to stay calm, assuming that there were vehicles where you could invest regularly, and a simple strategy would have been so rewarding.
Okay. It's inevitable that the volatility will happen, as you rightly said. Nobody can even predict it. That's the character of the market. At times it goes down, which has we recently witnessed as low as 2%. So keeping calm, that's a human psychology. I mean, come on, how can I keep calm? I mean,
2% in a day.
Yeah. I mean, how can I keep calm? I mean, in such a situation, hand-holding is important, all that is important, seeking advice is important. What is important?
Two things. You have to really work on the manageables. You can't really worry about anything which you can't manage. You can do two things. One is watch less. Switch it off. Don't look at your portfolio every day. Don't look at, don't get bogged by, don't get gripped by this whole panic or the doomsday being painted. This other thing that you should do is take a practical approach to your asset allocation. Everybody thinks that, 8 months ago, we were getting questions that which is the best small cap fund to invest, because it went up by 80% last year, some of the good ones. So everybody wanted small caps. Now the big decline in small caps, everybody is worried and scared and just waiting to run away. It doesn't work like that. I think having the discipline to be in the right vehicle which will not scare you out of the market. For example, a person who has never invested in the market is extremely conservative, small investor, and so he should start with those equity income fund, even with his long-term money, where only a third of the money is in equity. Assuming some person has a little bit of experience and can still absorb the ups and downs of the market still, but has not been an experienced investor, he hasn't seen the market for a long period of time, he should still continue with, he should start with either a tax saving fund where you get stuck for 3 years, so you can't get out once you invest. So panic also won't drive you out of the market, which is extremely important. The other is that or balanced fund, if you don't need to invest for taxes, saving taxes, and then being in a multi-cap fund, keeping things simple, it helps, because what we find is that something which does exceedingly well is also the segment which does extremely poorly. For example, small caps did exceedingly well last year. Small caps did very well 2 years back. They are the best performing fund over the past 10 years or 12 years or 15 years long term. But if you recall what happened in 2008, they are the ones which went down by 80%. Your 100 rupee turned into 20, and that is scary. And most investors, so sector funds, extremely narrow focused volatile funds like the small caps, they can scare you. So they are not meant for everybody. They are not mainstream vehicle. Keep it simple. Equity income fund for starters, no experience, conservative. Somebody who knows a little bit, drifted into the market, tax saving or balanced fund or multi-cap fund, and that does the job. That does the job of your long-term investing.
So right vehicle is extremely important.
Yes.
And as you are reaching the goal that you have set for yourself,
taking money out beforehand,
money out
methodically,
in a systematic manner is extremely important, and that will help you to keep calm. Moving on to the next section, which is the Q&A section, where you send us the questions and we reply to the queries that you send us. And the first question is from TP Singh. He says, in the current market scenario, when it is so volatile, should I invest more in equity or debt? I'm 64 years old.
You can't decide it now, and more so for a 64-year-old person. I think it's important to devise your rules. Decide on an asset allocation, and assuming that you don't need any income from your investment, these are still your long-term investment, just decide on a allocation. 50% of your money will be in equity, 50% in debt, and depending on what happens every 6 months, either equity does well or equity does poorly, this allocation will change. Rebalance.
Okay.
If you rebalance it, things will be taken care of. You will be buying something which has gone down. You will be selling something which has gone up, and this is the way to go. You can't really time the market. You can't be 100% equity, 100% debt based on a view that where the market is likely to be. All you can do is, and it is undesirable. It can't be done, and it can't be done on any objective, formula. So don't do that. Rebalancing, and 2 rules to follow. If you have decided on 50% equity, 50% debt, you should decide on a time frame, because many a times nothing will happen. Equity and debt both will keep going up, and it will largely be in the region of either 52% or 48%. So don't do anything if there is just a 10% variance. If equity becomes 55 and debt becomes 45, don't do anything. But assuming it crosses that threshold, then act. and do it in a manner that you are aware of the tax implication of that, or there could be an exit load implication. Tax implication, because less than 1 year old investment are taxed differently. Less than 3 year old investment in fixed income is taxed differently, and so be aware of this. And there is exit load on different kind of investment for different period of holding. So be aware of that, and I think doing having a periodic rebalancing plan, keeping an eye on our asset allocation itself will do the job.
Okay. Jagjit has written, as per my understanding, it is risky to invest in equity at higher PE levels as they are currently. Should an investor immediately stop investing in equity funds at a higher PE, especially if the chances of getting low PE in near future is nil?
A very difficult question. And no, but broadly what he's saying is that when markets are cheap, one should be in equity when markets are not so cheap. But defining that whether the market is relatively cheap or expensive is very difficult. Markets can be expensive, and they can remain expensive for a long period of time. It happened in 2005 that market was expensive. Corporate earnings was going up dramatically. Market was expensive. Even today we find that there are companies which are growing very rapidly, and they are very expensive, and they remain expensive. If you look at the most priciest companies, something like ABB, a P price earning ratio 50, Bajaj Finserv, and it has remained like this for a long period of time because these companies are growing very rapidly. So price earning ratio is a function of the growth, and to find that when it is relatively cheap or it is too expensive that it will correct is very hard. Which part of the market? What is your portfolio? So it's a very nuanced question. I would say that generally yes, but there is a great risk that you will be left out of the market when the big moves happen. Markets go up and go down when you least expect it, and so my basic advice will be that be dominantly invested. Manage something which you have a control on. You have a control on your dividing your long-term money, short-term money. Long-term money should be in equity. Have an asset allocation plan. That okay, this is your long-term money, but you will still be 60% equity and 40% debt, and you will rebalance it every 3 year, 4 year, every 1 year or so, every year or two.
In favor of 50-50 or
maybe 60-40, 50-50, whatever. But the idea is that enforce a discipline based on controllables on which you have a say, not on the market, because markets can remain expensive, and you will miss a big run. It happened from 2005 to 8. Market was expensive and it went up from 2,800, 4,000 to 20,000. So you miss this 5 times multiple. And when it will happen, you don't know. You will be in dismay, you will be in awe that, oh, something dramatic is happening. You will be in disbelief, and markets will go up. So the big moves in the market happen when you least expect it, and you will be left out of the market. So having that asset allocation plan ensures that you will be able to participate in that.
Very well answered. Ashok says, what is side pocketing in mutual funds management? How does it help investors?
Side pocketing is not a metaphor. It literally means what side pocketing should be. You have a mainstream fund, something goes wrong, you keep it aside. You keep it in the side pocket for it to be resolved, and you ensure the functioning of a mutual fund. I'll cite you of the big mutual fund at work. I'll tell you the rationale for this, and I'll give you an example.
Yeah.
Assuming there is a 1,000 crore fund, of which 50 crore is invested in a bond of a company which defaults. It does not pay the interest and principal on time. So the day this happens, this fund gets valued at 1,000 crore, immediately becomes 950 crore. So your 20 rupee, and assuming that the fund had a NAV of 20 rupee, it will also lose 5%. It will also become 19 rupee. But the problem is that this 1 rupee is written off in the NAV, but it is actually not worth a write-off. This 1 rupee or the 50 crore in the 1 rupee on a per unit basis, or 50 crore on an aggregate basis of a fund, maybe 50 crore will be recovered, maybe 40 crore will be recovered, maybe a substantial part will be written off, but that will be proven over a period of time. The principle of running a mutual fund is that there are three kind of possible, there are three constituents to it, kind of investors. The investors who are already invested, the investors who are getting out of the fund, and the prospective investors who will come into the fund.
Right.
By side pocketing this 50 crore into a fund on that day itself, when it is hit by this calamity or this write-off, will ensure that even if the investor gets out, he will be entitled for any recovery in the future on that fund.
Okay.
By not side pocketing it, there is a possibility that this 20 rupees NAV becomes 19 rupee, and an investor gets out and he will get 19 rupee, and end of the story for him. And a future investor comes, and that is the time when this money will be recovered. He will be getting the money, he will be getting the benefit which he should not get. A future investor who comes into the fund, when the fund is able to recover that money, when it will be returned back. So
whatever the recovery percentage is will be given to
all the investors who were there on that day. Okay. So the money which goes bad, which turns, which is put in the side pocket, all the people who are genuinely entitled for that will get it at a future date, subject to resolution or realization. So this is what side pocketing is, and I think it is very much in the spirit of mutual fund, that side pocketing. SEBI is trying to devise the rules for side pocketing. It will ensure that people don't lose money, or even if they lose money in the short run, whatever is their entitlement, they will be able to recover it in due course.
Okay. Moving on, we have a question from Rakesh. He says, is there any advantage of investing in mutual funds through multiple folios? How many folios should one ideally have?
There is absolutely no advantage of having multiple folios. It is possible to have multiple folios, but I don't see any critical advantage. It could, in the past, there was a possibility of, managing your taxes by making sure that because if you have a single folio, the principle being followed is first in, first out. If you accumulate, if you buy mutual funds, and anytime you sell, it is assumed the taxation rules ensure that what you bought first is assumed to be sold first. So there is a first in, first out principle being followed in redemptions. If you have multiple folios, you can decide to sell those units which was bought later, because they are all kept in separate folios. But I don't see any significant advantage of this, because once you have a mutual fund, the taxation rules have changed. You have to hold debt funds for 3 years to get the beneficial tax advantage, or hold mutual fund. Equity funds are taxable at 10% for the long term and 15% for the short run. So I don't see that you will have any great advantage.
Okay.
And it will also complicate your paperwork and holding and the way you file it, return it.
Okay. Will investing in an NFO help to minimize risk? Will it be more beneficial in the current market situation? Asks H.L. Chopra. What's your answer?
Generally speaking, one should avoid NFO, because when investing in mutual fund, all that you have is a past track record, and a new fund offer has no history. I don't see a novelty in any new fund today. Many mutual fund companies are launching a new fund because they have been allowed by SEBI to have X number of funds. So if they find that some of the slots are vacant, they are launching those funds. But I don't see any reason why an investor should be, and it does not minimize risk. In fact, I would say that you have greater uncertainty, because you don't know how this fund will do. And the only way to invest in a mutual fund is to look at good history, look at fund which has done well in a rising market as well as a falling market, and the fund manager remains the same. Go with it.
Okay. Well, that's all we have in today's Investors Hangout. We will be seeing you soon, but in the meantime, as Dhiren advised, make sure that you continue to invest regularly and also do not panic. Bye for now.